The 2008 crisis wiped out over $10 trillion in global wealth. But the numbers we're seeing now are on a completely different scale. The mainstream narrative wants you to believe in a soft landing, that the worst is behind us. That's a dangerous fantasy. This isn't a single crisis like subprime mortgages. This is 4 distinct crises: sovereign debt, commercial real estate, consumer collapse, and geopolitical shifts, all converging on a single timeline around 2026. By understanding how these mechanisms connect, you can see the real threat and, more importantly, prepare for it. Global sovereign debt has now surpassed the record set just after World War II. The U.S. national debt is over $34 trillion. Japan's debt-to-GDP ratio is pushing 260%. But the number that matters isn't the size of the debt, it's the cost to service it. That's the mechanism of the doom loop. As interest rates rise, the money governments must spend just to pay interest on existing debt crowds out everything else: defense, infrastructure, social programs. It forces more borrowing just to cover the interest payments, which in turn increases the debt, requiring even higher interest payments. It's a perfect self-reinforcing feedback loop. In 2008, central banks had a clear playbook: slash interest rates to zero and launch quantitative easing. They could flood the system with liquidity. Today, their tools are blunted. They're trying to fight inflation with quantitative tightening, which is the exact opposite of what they need to do to manage a debt crisis. They're actively pulling liquidity out of the system, while the system is screaming for more. The Bank of Japan is trapped. The Federal Reserve is trapped. The European Central Bank is trapped. They can either let inflation run wild by monetizing the debt, or they can try to maintain credibility and crash the economy by forcing higher rates onto unsustainable debt loads. This is the fundamental difference from 2008. Then, it was a banking crisis with a clear, albeit painful, solution. Now, it's a sovereign solvency crisis with no clear exit. Look at the timelines. The U.S. Treasury must refinance trillions of dollars of debt in the coming years at these new, higher rates. Each refinancing event doesn't just add to the debt, it structurally increases the government's mandatory annual interest expense, permanently shrinking its fiscal flexibility. This isn't a cyclical problem, this is a structural break. The system is designed for perpetually low rates. We are now in a different regime, and the foundation cannot hold. The first domino isn't a bank like Lehman Brothers, it's a government bond auction that fails. When the market questions the credibility of a major sovereign borrower, the entire architecture of global finance, which is built on the risk-free asset, begins to crumble. That's a crisis for which there is no bailout. While governments grapple with their doom loop, the commercial real estate market is already in freefall. The remote work revolution wasn't a temporary shift, it was a permanent devaluation of office space. Vacancy rates in major metropolitan areas are at 30-year highs and still climbing. But the real alarm bell is in the commercial mortgage-backed securities market. CMBS delinquency rates are accelerating past the warning levels we saw in 2007. This is the canary in the coal mine, and it's already gasping for air. The problem is concentrated in the regional banking system. These banks hold a disproportionate share of commercial real estate loans. They don't have the diversified asset base or the capital buffers of the megabanks. A study from the National Bureau of Economic Research found that if CRE prices fall just 10%, and they've already fallen much further in many markets, it could trigger failures in dozens of regional banks. We got a preview of this with Silicon Valley Bank and Signature Bank. That was a crisis driven by treasury bonds. The commercial real estate problem is an order of magnitude larger, and the timing is precise. We are approaching the 2025-2026 maturity wall. This is when trillions of dollars in commercial real estate loans originated a decade ago during the era of near-zero interest rates, come due and need to be refinanced. But the properties are now worth 30-40% less, and interest rates are 4 or 5% higher. A building that could support a $100 million loan at 3% interest cannot support a $70 million loan at 8% interest. The math simply doesn't work. Owners are simply walking away, handing the keys back to the lenders. The lenders, primarily the regional banks, are now holding rapidly depreciating assets on their books. This creates a vicious cycle. As banks are forced to write down the value of these loans, their capital ratios deteriorate. To shore up their balance sheets, they tighten lending standards for everyone else: small businesses, consumers, even other real estate developers. This credit contraction starves the real economy of oxygen, just as the sovereign debt crisis is putting pressure on government spending. The two crises feed each other. The commercial real estate implosion isn't just a sector-specific problem. It's the trigger for a systemic credit event that will make the regional banking crisis of 2023 look like a minor tremor. The fuse is lit, and the maturity wall in 2026 is the bomb. While the commercial real estate bomb ticks down, the foundation of the entire economy, the American consumer, is already cracking. You see it in the numbers the mainstream doesn't want to highlight. Credit card and auto loan delinquencies are now accelerating past the peaks we saw in 2008. But this time, the mechanism is different. It's not about subprime mortgages for overvalued homes. It's about credit cards and car loans for basic survival. The average household is tapped out. using debt not for discretionary spending, but to cover essentials like groceries and utilities that have skyrocketed in price. The buy now, pay later phenomenon is a dangerous illusion masking true consumer distress. It's not a convenient financial tool, it's a symptom of cash flow collapse. These services fragment a single purchase into multiple future obligations, creating a complex web of liabilities that don't show up on traditional credit reports until they're already delinquent. It's subprime lending dressed in Silicon Valley's clothing. And now, student loan payments have resumed, draining billions of dollars per month from the disposable income of millions of Americans. This isn't a minor headwind, it's a direct withdrawal of fuel from the consumer engine. The car loan is the canary in this coal mine. Historically, the car payment is the last bill an American will skip. Before the mortgage, before the credit cards, you need the car to get to work. But now, auto loan delinquencies are hitting record highs. Why? Because the average new car payment has surged past $700 a month, and used car prices remain elevated. People are stretched to the absolute limit. When the first major wave of job losses hits, and it will, as the credit contraction from the regional banking crisis chokes small businesses, these delinquencies will turn into defaults overnight. This consumption collapse will hit corporate earnings far harder and faster than in 2008. Back then, the problem was concentrated in housing. Today, the problem is the entire consumer balance sheet, and the dominoes are already lined up. The first three crises, sovereign debt, commercial real estate, consumer debt, are internal mechanical failures. But the fourth crisis is an external shock that changes the entire game, the accelerating de-dollarization of global trade. For decades, the US dollar's status as the world's reserve currency has been an exorbitant privilege, allowing the US to run massive deficits and export its inflation. That safety valve is now closing. BRICS nations, led by China and Russia, are systematically creating alternative financial channels, settling trades in yuan, rupees, and even gold. This isn't theoretical, it's happening now. Saudi Arabia is openly considering pricing oil in currencies other than the dollar. This creates a fundamental shift in global liquidity. In 2008, when panic hit, there was a global flight to safety to US Treasury bonds. The dollar strengthened dramatically, which gave the Federal Reserve immense power to stabilize the system. In the 2026 scenario, that may not happen. If global traders are no longer compelled to hold dollars for energy transactions, the demand for US dollars in a crisis could be significantly weaker. Instead of a flight to safety, we could see a flight from perceived risk, which would include US assets. This would trigger a vicious cycle. Weaker demand for dollars leads to a weaker dollar, which imports inflation, forcing the Fed to keep rates higher for longer, which further exacerbates the sovereign debt and commercial real estate crises. The mechanism here is a loss of confidence in the entire system's foundation. The US government's ability to finance its debt relies on perpetual global demand for treasury bonds. If major holders like China and Japan continue to diversify away, who will buy the trillions of dollars of debt the US needs to issue? The Fed would be forced to become the buyer of last resort, effectively monetizing the debt and unleashing hyperinflation. It's an impossible choice. Either let the bond market crash and trigger a systemic meltdown, or print money and destroy the currency's value. This geopolitical trigger turns a severe financial crisis into an existential currency crisis, something that was not even a remote possibility in 2008. The world is actively building an alternative financial architecture, and when the next crisis hits, the United States may find itself isolated, with its traditional tools rendered useless. The convergence of these four factors creates a feedback loop of unparalleled destructive potential, a scenario for which the 2008 playbook offers no solutions. And this brings us to the trap the Federal Reserve has walked right into. They told you inflation was transitory. The data now shows it's anything but. Core services inflation, which strips out volatile food and energy, remains stubbornly high. This is wage-driven inflation, and it's the hardest kind to kill. We're seeing wage price spirals in sectors like healthcare, hospitality, and professional services. When people get raises to keep up with prices, businesses raise their prices to cover the higher labor costs, which forces people to demand even higher raises. It's a feedback loop that has nothing to do with supply chains. The Fed now faces an impossible choice, a dilemma that simply didn't exist in 2008. In 2008, the problem was deflationary collapse. Their job was simple, print money. Today, their job is schizophrenic. To fight the inflation they helped create, they must keep interest rates high, which we've already seen crushes the sovereign debt market and commercial real estate. But if they capitulate and cut rates to save the banking system and the government from its debt spiral, they pour gasoline on the inflationary fire. They are trying to fight a fire and a flood at the exact same time with the same tool. It cannot work. This is the fundamental policy difference. The responses that worked in 2008, zero interest rates and quantitative easing, are the very policies that would be catastrophic today. They would signal a surrender to inflation, potentially triggering a collapse in the dollar's value as the world questions the Fed's resolve. The entire global financial system is built on the credibility of the US central bank. If that credibility shatters, the inflation we've seen so far will look mild. The policy toolbox is empty. There is no Volcker moment possible today because the level of debt in the system is so astronomically high that Volcker-level interest rates would cause an instantaneous depression. The Fed is out of ammo, and the inflation genie is out of the bottle. While the Fed is trapped, another time bomb is ticking right on schedule for 2026, the collapse of the retirement system. This is a demographic crisis that wasn't a factor in 2008. Pension funds, both public and private, are dangerously underfunded after more than a decade of artificially low interest rates. They relied on achieving 7 to 8% annual returns to meet their obligations. In a world of 5% interest rates, that return target is a fantasy. Their models are broken. The classic 60-40 portfolio, 60% stocks, 40% bonds, which was the bedrock of retirement planning for generations, failed spectacularly in 2022. For the first time in decades, both stocks and bonds fell together. That wasn't a fluke, it was a preview. In the liquidity crisis we discussed, the correlation between all assets goes to 1. Everything falls. The 60-40 portfolio offers no protection in the kind of systemic meltdown that 2026 threatens. It's a strategy designed for a world that no longer exists. Now, layer in the demographic reality. The largest generation in American history, the baby boomers, are hitting peak retirement age. This isn't a slow trickle, it's a wave. They are transitioning from being net buyers of assets, accumulating stocks and bonds for their 401ks, to being net sellers. They must sell to generate income to live on. This creates a structural, relentless selling pressure on financial markets. Who will be the buyer? The younger generations are smaller in number and, crucially, are already burdened by student debt and inflated living costs. They lack the capital to absorb the trillions of dollars in assets the boomers need to sell. And the final pillar, Social Security, is facing its own insolvency threshold. The Social Security Trust Fund is projected to be depleted right around 2033, but the fiscal pressure begins much sooner. As more boomers retire, the system pays out more in benefits than it collects in payroll taxes. This will force the government to either make drastic cuts to benefits, which would crush consumer spending further, or increase borrowing to cover the shortfall, which exacerbates the sovereign debt crisis we started with. The retirement system isn't a separate issue, it's a key driver of the coming liquidity drain. It ensures that any market recovery will be anemic at best, because the natural buyer of last resort, the retiring saver, has vanished. They've become a forced seller. This creates a downward spiral that feeds directly into the liquidity crisis, ensuring that when the crash comes, the rebound mechanisms that worked in the past will be broken. Just when it feels like the pressure can't get any worse, we have to turn our attention to the physical backbone of the global economy, supply chains. The pandemic exposed a hard truth. Just-in-time inventory systems work beautifully in stable conditions, but when they fail, they don't fail slowly. They collapse all at once, and despite what policymakers claim, that fragility hasn't been repaired, it's only been masked. Bringing manufacturing back home is an expensive, inflation-driven process that will take decades, and in reality, it has barely started. Until then, the global economy remains dangerously exposed to single points of failure. Consider the choke points. Taiwan dominates advanced semiconductor production. China controls the supply of rare earth minerals that power everything from electric vehicles to defense systems. These are not just economic dependencies, they are strategic liabilities. In 2008, supply chains broke because demand evaporated. In the next crisis, the supply chain itself could be the trigger. One geopolitical shock, a blockade, expanded sanctions, or internal instability could sever a critical link overnight. When that happens, inflation wouldn't rise gradually. It would surge instantly, overwhelming the system. At that point, the Federal Reserve's battle against inflation becomes irrelevant, because monetary policy can't manufacture chips or mine rare earths. This is where supply chain failure feeds directly into the liquidity crisis. A sudden supply shock pushes prices higher. The Fed, reacting to higher inflation, is forced to keep financial conditions tight or tighten them even more. That pressure intensifies stress in commercial real estate and corporate debt markets, triggering layoffs and weakening consumer spending. But because the root problem is supply, not demand, prices refuse to come down. The result is the most toxic outcome imaginable: stagflation, higher prices alongside a shrinking economy. Policymakers have no effective tools for this scenario. The supply chain is the true wild card, the non-financial spark that could knock an already unstable system off balance far sooner than anyone expects. And if a supply chain shock is the trigger, the derivatives market is the explosive material waiting for a spark. The notional value of the global derivatives market is estimated at over $600 trillion. That's not money that exists. It's a web of promises and insurance contracts. And since 2008, the risk hasn't disappeared. It's just been moved. Regulation pushed a lot of derivatives trading into central clearing parties. That was supposed to reduce risk by creating a central counterparty, but it also created a single point of failure. If a clearinghouse fails, it fails catastrophically for everyone. The new subprime is hiding in plain sight: interest rate swaps and credit default swaps. Think about what's happening. Corporations, governments, and investors all took on debt when rates were near zero. To hedge against the risk of rates rising, many entered into interest rate swaps. Now rates have skyrocketed. The entities on the losing side of those swaps, the ones who promised to pay if rates went up, are facing margin calls they cannot meet. It's the same mechanism as 2008, just with a different asset class. Instead of insurance on subprime mortgages failing, it's insurance on interest rates failing. The interconnectedness is the real danger. A failure in the commercial real estate market triggers credit default swaps. The rising cost of sovereign debt triggers payouts on interest rate swaps. A corporate bankruptcy triggers both. Because these contracts are all linked through a handful of massive global banks and clearinghouses, the failure of one creates a domino effect. The system is so leveraged that a relatively small initial loss can be amplified into a systemic collapse. In 2008, the problem was contained, albeit painfully, to the banking sector. Today, the derivatives market ties the banking sector, the corporate sector, and the sovereign debt market together into one inseparable knot. When the margin calls hit, there won't be a buyer of last resort big enough to stop the cascade. The entire edifice is built on confidence, and the data shows that confidence is already cracking. The dominoes are lined up. We're just waiting for the first one to fall. All these interconnected risks lead to one inevitable outcome: a liquidity crisis, where the entire financial system seizes up. You saw a preview in March 2020 and again with the UK gilt crisis in 2022. The Treasury market, supposedly the most liquid market in the world, froze. That wasn't a one-off event. It was a stress test the system barely passed. The underlying structural vulnerabilities weren't fixed. They were papered over with temporary interventions. The problem is the plumbing of modern markets. High-frequency trading and algorithmic strategies now dominate. They provide liquidity in calm markets, but they amplify selling pressure in a panic. The algorithms aren't programmed for nuance. They're programmed to sell when volatility spikes. So a small wave of selling triggers automated responses that create a tsunami. Liquidity doesn't just dry up, it evaporates instantaneously. In a true crisis, the correlation of all assets goes to one. Stocks, bonds, real estate, commodities, they all fall together because the one thing everyone needs is cash, and the only way to get cash is to sell whatever you can, at any price. This is where the Fed's limitations become catastrophic. Their balance sheet is already bloated at nearly $7.5 trillion. In 2008, they started with a clean slate. They had unlimited room to expand their balance sheet as the lender of last resort. Today, they are trying to shrink their balance sheet through quantitative tightening at the very moment the system will be screaming for liquidity. They will be forced into a chaotic about-face, trying to reflood a system that is actively hemorrhaging. But their firepower is diminished. The world is watching their credibility on inflation. A massive, panicked return to quantitative easing would signal a total loss of control, potentially triggering the very currency crisis we discussed. The 2026 liquidity crisis won't be a problem of a few insolvent banks. It will be a margin call on the entire global financial system, and there may be no one left with the capacity or the credibility to answer it. And when the financial dust settles, we face a deeper, more insidious crisis that will strangle any potential recovery: the collapse of human capital and productivity. This is a silent erosion that has been happening for years, and its consequences will be fully realized in the aftermath of a 2026 meltdown. The remote work revolution, while offering flexibility, has created a measurable and sustained productivity penalty across multiple industries. The data is clear. The spontaneous collaboration, the mentorship, the rapid problem-solving that happens in person has been lost. Organizations are now hollowed-out versions of their former selves. The Great Resignation and the subsequent quiet quitting phenomenon weren't just trends, they were a massive transfer of institutional knowledge out of the workforce. Experienced workers retired early or left for other opportunities, taking decades of nuanced understanding with them. The teams that are left are often less experienced, less connected, and operating in fragmented digital silos. Skill gaps in critical industries like skilled trades, engineering, and healthcare are widening into chasms. We are trying to run a 21st century economy with a depleted and disengaged workforce. This creates a fundamental divergence from 2008. In the wake of the great financial crisis, there was a deep pool of talented, experienced workers ready to be rehired the moment the economy recovered. Companies could tap into a reservoir of human capital to fuel the rebound. That reservoir is now dry. The demographic wave of boomer retirements is a one-way valve. The workers who were laid off in 2008 are not coming back in 2026. They're gone. This means that any economic recovery will be painfully slow and anemic. You can print money to recapitalize banks, you can restructure debt, but you cannot print experience, institutional knowledge, or productive capacity. A financial crisis breaks the machine. A human capital crisis means you no longer have the engineers who know how to fix it. This structural deficit in productivity ensures that the long-term economic damage from the 2026 crisis will be far deeper and more persistent than anything we experienced 15 years ago. The engine of the economy is broken, and we've thrown away the manual. So what do you do with this information? The goal isn't to predict the exact day, it's to position yourself to survive the mechanism. First, Focus on liquidity and reducing leverage immediately. Cash is not trash in a deflationary crash, it's oxygen. Second, understand the critical difference between an inflation hedge, like gold, and a crisis hedge, like short-dated government bonds or certain currencies, which provide stability when everything else is selling off. Geographic diversification of assets is no longer a luxury. It's a necessity for basic financial hygiene, but the most valuable assets won't be on a balance sheet. Your skills, your adaptable network, your ability to generate value outside a collapsing system, these will be worth more than any paper asset. This isn't about getting rich. It's about preserving what you have when the tide goes out and reveals who's been swimming naked. These crises converging create a scenario without modern precedent. The data shows the mechanisms are already in motion. Subscribe for the specific survival blueprint I'm releasing next week. The question is whether you'll be positioned to survive or be another casualty.